bottom line, out of the 300 million users added in the last 2 to 3 years, 200 million have been women. And when you hear that, you're like, wait, and there's nothing focused on women. And then you look, hey, when did Nykaa start to grow? When did all these beauty brands start to grow? And then it's not a coincidence that they've all started to grow in the last 2 years, because that's when the consumer came on. So
Welcome to another episode of the Startup Operator Podcast. I'm your host, Roshan. I have with me today Anant Vidur Puri, who is an investor with Bessemer Venture Partners, and he focuses particularly on consumer tech for India, Southeast Asia, and enterprise SMB SaaS being built from India, Southeast Asia for the world. We have lots to talk to him about investing in startups, so let's get started. Hey Anant, welcome to the podcast.
Hey Roshan, thank you so much for having me.
Thank you for making the time. So, Anant, before we get started, I was quite intrigued by your focus, consumer tech and enterprise SaaS. Now, I've operated in both these domains, and I feel they are like worlds apart, right? So, what do you see in both these markets that are appealing to you?
Well, I think focus is probably the wrong word. Probably lack of focus maybe a better word to use. But see, I think, look, when you're investing in India, you just can't ignore the consumer opportunity, because there are a billion people here, right? So the consumer piece is just there, and it's been kind of like the low-hanging fruit for a long time. Like if you look at 2013, 2014, around that time it was mostly consumer tech, and SaaS has kind of started happening in the last 3-4 years. I mean, I know it was fresh in browser stack, but I think probably the last 2 to 3 years is when it's kind of really coming to its own. So I think it's mostly it's like a sign of how the times have changed. I think even as a fund, I think in say 2012, 2013, we were doing mostly consumer tech. And then I think of late we started doing a little bit more SaaS out of India. And of course, as a fund across the world, we've been doing mostly SaaS for a long time. So I think it's just a sign of the times. At the same time, I do think while the sectors are quite different, I think it's actually quite interesting to have a look at both, because if you see a company like, say, you have a company like Swiggy on one hand, which kind of grows at whatever 300-400% year over year, number of transactions and all that, and then you have another company on the other side like a Perfios, which is more an enterprise SaaS company. Both those companies grow in very different ways. They have different kind of gross margin profiles. Like Swiggy, to 20% kind of take rate business. Perfios 90% gross margin business. One business has like a lot of consumers. You're trying to trying to kind of get like millions of consumers to order. The other has like 40 customers. Each of them are like $500,000 to $1 million contracts. So they are very different businesses, like you said. And it's quite interesting. If you look at both those kinds, then you kind of appreciate the strengths of each business. You start to appreciate gross margin a lot more if you start doing enterprise SaaS. If you've just been doing consumer tech, you're just used to like seeing such abysmally low gross margins. And then enterprise SaaS just tells you, hey, wait, you can make money, on each transaction. So I think it's definitely not easy to straddle both, but I think it's just a sign of the times.
Yeah. No, I mean, I see some commonality as well, some definite commonality between both these worlds. Take, for example, the lifetime value, right? I mean, something that's big on consumer tech. I mean, is something that is hugely prominent in SaaS as well, where you talk about negative churn and so on and so forth, right? Growing the value of a deal per se, right? And the fact that, I mean, you're seeing a lot of brand investments in SaaS now, which is, again, something ubiquitous on the consumer side, right? So yeah, I mean, a lot of common aspects as well in both these worlds.
Yeah, look, I think every business is fundamentally, you have to make profit. Profit is revenue minus cost. You get revenue by acquiring customers and making sure they stick. So I think whether it's consumer or enterprise, anywhere else, you always have to make your lifetime value to CAC economics work. So yeah, at that, I mean, definitely, I think the fundamentals of business don't change. I think, yeah, there is a lot of, I think, look, if you abstract out what the business does, at the heart of it, there's always a customer, there is always a product being sold to the customer, and there's always the intent to make sure the customer keeps coming back to buy more of either the same or a different product. Now, in the case of a consumer business, like say a food delivery business, you would be like, okay, let me acquire a customer, let me first sell a biryani, then let me sell a different kind of food. Whereas in SaaS, you'll be like, okay, let me first get them on board for my product A, then let me try and cross-sell my product B. And yes, in one you will have, in SaaS, I think net negative retention on the enterprise side is almost like you need to be at that level. Whereas on the consumer side, if you have like 30%, 40% flatline retention after 12 months, that's like best in class. So yeah, that modulation is there, but I agree. I think at the heart of it, it's always a product being sold to a customer and you want them to come back again and again.
Right. At some level, it's that easy, right? So, or that simple rather. Yeah. So, another thing that I was curious of, based on what you said, is India is such a huge market that, arguably every market looks lucrative, right? I mean, you can even say the shoe shine market here will be $1 billion plus a multi-billion-dollar market. So how do you develop focus areas, and how do you build, let's say, some kind of a thesis around, how you're going to approach investments in a particular sector and so on?
I think that's very, very well said. I think in India it's very easy to get distracted, and I think we've all, at least I have been prey to that in the past, where I've been looking at, health tech is a large market, insure tech is a large market, fintech is a large market, consumer tech. It's just like everything is a large market of 1 billion people. I think the way it kind of boils down, at least for me, is that, and I've started to do this a lot more over the past maybe year and a half or so, as I think just trying to build a little bit more focus, is what are the markets that you understand better, and where have you spent a little bit more time, and where is it that you see a little bit of an unfair advantage for yourself as well as for for someone who is in this business. So for me, for example, while consumer tech is a very broad word, like in India, I think there are 2 or 3 kind of sub consumer tech thesis, for example, that I spend a lot of time on. So one of my favorite ones is around the fifth. It's what I call the female consumer thesis. If you look at most of large consumer tech companies, starting from Flipkart, Amazon, Myntra, any of the big basket, Farmeezy, Swiggy, Urban Company, all of those companies, and a lot of them are in our portfolio, we kind of realize that a lot of them are very male dominated. For example, almost 60-70% of customers tend to be male in a lot of these platforms. That hasn't changed. It used to be 85-90%. That's changed a little bit over the last 2 to 3 years. And then if you go one level deeper, you're like, okay, wait, why is this happening? I think 2 years ago, that was what the split of the internet population in India was. It was 75% male, 25% female. And then the geo revolution happened, and a lot more women came onto the internet, and we can go into the reasons why that was happening. But bottom line, out of the 300 million users added in the last 2 to 3 years, 200 million have been women. And when you hear that, you're like, wait, and there's nothing focused on women. And then you look, hey, when did Nykaa start to grow? When did all these beauty brands start to grow? And then it's not a coincidence that they've all started to grow in the last 2 years, because that's when the consumer came on. So that's a thesis which I'm fascinated by. I think these consumers have been neglected for so long. And even if you look at the offline world, just the way the social construct in India has been constructed, a lot of times the woman consumer was never the buyer. She was never making the buying decision for whatever reasons. And I don't want to get into that. I think that's a whole other thing. But you're now seeing that women are at the point of purchase. They're making the buying decision. They have a lot more free will of making those buying decisions. There's a lot more women in the workforce, so they're buying more things. There's a lot more independent women who are earning for themselves and hence buying for themselves. So a lot of those socio-demographic trends have led to this, and I think the internet is very well suited for it, because I don't think the offline world is very well suited for a female-focused commerce, because you can't have a shop which is like, hey, you know what? Let me selectively acquire women, women users. You can't do that in a mall. But on the internet, you can actually, segment the user out. So now, is that consumer tech? Yes, but for me, that's a very specific piece inside consumer tech. And so I think that's for example, one of the sub theses that I have with the consumer.
Right. This episode is brought to you by Mulya. You want to move fast? Sure. But without breaking things? Now that's a hard ask. The thing is, once you have some base of users and customers, you just cannot afford to risk quality. So how do the likes of Cred, Swiggy and CureFit, some of India's fastest growing startups, ship at lightning pace and delight their users and customers? Simple, they're working with Moolia as a strategic quality partner. Moolia is India's most talented and passionate community of testers. They've helped prevent thousands of bugs and regression issues. So, as a CTO or a product owner, if you want to reduce tech debt, especially while you scale, do check out Moolia.com. I've interviewed Moolia's founder and CEO Pradeep on the podcast earlier, and we spoke about how startups can improve quality while scaling and things to that effect. You should definitely check it out. I'll link to it in the description below. Now back to your regular programming. Interesting. So that is the beginning of the journey, right? I mean, then you have the part about, actually, identifying founders or startups that fit that sort of a thesis, and then, being attractive enough for them to, sort of partner with you. How does that happen? I mean, so typically, how does your pipeline get generated and so on?
I mean, it's a combination of just meeting people who refer you to other people and just kind of reading. I think a lot of my pipeline comes from, a lot of it is just kind of, browsing the internet, trying to see what's happening, who's doing what. And this comes from, reading a lot of content, either on your story, paying for you to can, whatever, choose your choice of platform, as well as a combination of just kind of seeing what's out there. I think one difference here is we follow what is known as a roadmap approach. So it's a little bit more top down. So Bessemer as a fund follows this, and I personally also do this. So for example, I have a female focused consumer roadmap. What that means is I've kind of in my head identified that, look, there are going to be these 3-4 women focused categories: beauty, personal health, intimate wear, fashion, health, like some 5 or 6 sub verticals within the consumer. And then I'm like, hey, let me try and find everybody who's trying to do this, because I know that these are the kind of companies I'm going to go after, because that's my roadmap. And then suddenly the entire sourcing problem becomes much more constrained, because now I'm not just looking at everything. I'm looking at female focused consumer internet companies focused on one of these 3 or 4 sectors. And then, because of the roadmap work, we've also done a little bit of we always usually have done a little bit of top-down work around what are the kind of metrics that you want to look at. We don't come in super early, so you won't see us doing like pre-idea, pre-product, kind of things. At least not me personally. I think as a fund, Bessemer, there are other partners who may do that. I probably do a little bit more. There is a product, something exists, something is getting sold. And so you have, we've done some work around what are the kind of metrics you want to look at. What are the key metrics to look at? I think the biggest question most people don't know is, okay, what are the 3 things I'm going to look at? So for example, when I look at a consumer internet business, I know I'm going to look at 4 metrics. I'm going to look at their conversions. I'm going to look at their cohorts. I'm going to look at their churn. And I'm going to look at their word of mouth growth. And for me, those 4 are just like A, B, C, D. I need to look at these. And that comes from the roadmap approach, because we spend a lot of time, okay, what are the 4 key metrics we need to look at? So that filters the pipeline down further. And the combination of the roadmap approach, choosing your thesis, choosing the key metrics you want to kind of see, and the stage you want to come in, that really helps.
Right. All right. Let's zoom out a little bit, and maybe help us take us through a day in your life. As a venture investor at Bessemer Venture Partners, what do you do through the day? What part of your day goes in, let's say, prospecting new companies versus talking to your other venture partners and so on and so forth. So just take us through your day.
Sure. Yeah. I was asked this question another time as well, and it was a very interesting answer. So look, most of the day goes in just meeting founders. Okay. Like, let's say it's a 10-hour day. 10 is for ease of calculation. Probably 5 to 6, which is 60% of the day goes in meeting new companies. You're meeting new founders. You're meeting founders you've never met before, or you haven't met for the last 6-12 months. You don't know where the business is at. And you're just trying to, meet them and learn about their business, and, just see if that is a fit, if there is a match, if there is something which is interesting. Then out of the remaining 4 hours, you probably spend 1.5 hours or so on your portfolio because you have a portfolio to manage, which could mean a combination of, hey, there's a board meeting, or hey, there's some kind of pending strategic conversation, there is a hiring interview, there's whatever, there is some kind of conversation with the founding team. And again, this is like an average. There may be days when this flips, but yeah. So that's 1.5 hours. And then, the last kind of 3.5 hours, which are 2.5 hours, which are left, that's a combination of introspection and reading. A lot of reading, because you have to remain up to date on what's happening in the world, who's doing what. And there's also has to be enough time for you to just, think about what it is that you learn during that day. Because I think when you're meeting 5 or 6 founders every day, you're learning a lot of new things. Basically each 45-minute to 1 hour meeting is that founder is telling you about their deepest passion in life, and really convincing you on why that is the next big thing in the world. And so definitely you have learned so much from that. So how do you just take it all in, modify your mental models, rehash your biases, throw them away, form new biases, whatever it is. But there is definitely a lot of that which I think that's the broad split, I would say.
Yeah. No, I've always wondered, I mean, every meeting with a founder or something must set you off on some sort of a rabbit hole quest, right? I mean, there's so many things that come up that you must want to know more about and so on. Yeah.
Yeah, and I think some of them more than others. I think each founder meeting usually, I mean, you will definitely learn a lot of things, like 3 to 4 things at the minimum, because every founder just has their own journey. And then there are those kind of meetings where you just sometimes connect so well with the founder, and then you just kind of start going deeper and deeper and deeper into things, and then you're like, hey, where did we start this meeting from? So for example, and this happens a lot. For example, when you're talking to a SaaS founder, for example, right? Because no two SaaS products are the same. They may be addressing the same market. They may be addressing, like, for example, even if they're both addressing the exact same, say, sales automation, or I don't know, pipeline prospecting ranking for sales in mid-market in, I don't know, Eastern Europe, that specific, but those two founders would still have very different problems that they've identified that they want to solve. And yes, from a broad business perspective, they're probably going out of the same share of the dollar or wallet, whatever it is, but you can just kind of get lost in those problem and product conversations because the founders are just living that, right? And sometimes you're like, wait, I never thought of it like this. And I think that's just fascinating, and I think that's probably what makes it like a little bit, that's probably what most VCs live for. I think it's hard to, I mean, look, it sounds very glamorous, but it's a hard job, meeting people, like 6-8 people every day, hearing about their passion, finding yourself, hey, what am I doing with my life? and then, probably saying no to 7 out of 8, or like 7.5 out of 8 of them. It's kind of a little bit, it can get to you. So I think those are the moments where you just learn so much, and it's quite interesting.
Yeah. Yeah, and not just any 7 or 8 people, right? I mean, these are probably the most smartest, most passionate people, most hardworking people around, for sure.
100%, yeah, 100%.
Yeah.
There are always people who are much smarter than you. So,
Yeah.
Constantly being reminded of that fact.
Yeah, it's quite a humbling experience. I kind of understand. So you've been with Bessemer for about 6 years now. You joined them in 2014. What has changed in those years, with the kind of founders and startups that you're meeting, right? Have you seen some sort of an evolution in that time frame?
100%. I think the average founder has just matured a lot more. I think, and it's a function of a maturing, the country as a whole, the startup ecosystem as a whole has matured in that time. And I think you're seeing that in the founders. You're seeing founders who are, you're seeing a lot of second-time founders, third-time founders who've been operators, like, they've been in companies like Flipkart or Swiggy or Amazon or whatever. They've seen some of these kind of, journeys as a as a person who was maybe 2 levels removed from the founders, and now they're becoming a founder, or maybe they were themselves a founder. So a lot of second time, third time founders. What that means is they are a lot more sophisticated on choosing their market, on being focused on the product, like, not just, hey, I want to solve food delivery. No, I want to solve food delivery in tier 2 cities for people focused on vegetarian, healthy food for home mothers. Like that kind of specificity is what you start to see. And that's always encouraging, because that tells you that people are realizing that focus is important. People are realizing that identifying the right problem is important. Then, of course, even when you get down to like company conversations, I think much more mature in hiring. I think 5-7 years ago, if you looked at people, a lot of their hires would come from personal networks. It's like, oh, I know this person from X, from Y. I think you're seeing a lot more professional, formal hiring happening. So a lot more new talent coming to the fore. And I think, again, on the product side, I think a lot more product focused founders, not founders who are trying to do X for India or Y for India, but founders who are fundamentally trying to build something new, not just for India, but also for the world. So, for example, a lot of SaaS that we see now, it's not like somebody's trying to, rip off a global product, price it 30% cheaper and sell it. It's like, hey, I want to build a new product which is, using, cutting edge AI, tech, whatever it is. So a lot more like, fundamentally new problems that they're trying to solve with the cutting edge product. So I think those are the three broad things which I see have changed.
Yeah. No, I mean, I agree with you 100%. The post Flipkart, Ola sort of founder talent base that it's created is just phenomenal, and I see that happen with SaaS also over the last, 3 to 4 years. And especially now going forward, I think the type of founder talent that will be set up is just amazing, right? And, these could be the top 100, 200 people in these companies, but still, you have like such a depth of talent, right? So that's pretty amazing.
It's
Now,
happening specifically in SaaS, actually. Like, I
yeah,
think you look
yeah,
at, just pick up the portfolio of Axel or Nexus or,
yeah,
these funds. I think, like, for example, Shaker at Axel does a phenomenal job at just finding these, people
yeah,
from Zoho and Freshdesk and ChargeBee and wherever else who are kind of about to leave and start a company. So I
yeah,
think it's happening a lot more in SaaS, in fact.
yeah, absolutely. I mean, I think it's a very tight knit sort of a community,
Right.
Yeah. So you moved to, startup investing from consulting, right? So one of the things I believe founders often lack is sort of a market or business. How should I put it? Like mm, an overview of the business or the market, right? Because oftentimes what you hear is like of a founder who's found a solution to a problem he was facing, or something which he was working in, right? So, and it's sort of like they chase that solution, and it's very difficult for them to sort of abstract themselves out of the problem and then look at the market as such. But as a consultant and as an investor, you keep looking at these markets as such, right? So that must be like a very good sort of a symbiotic fit, I would assume, right? I mean, when you meet founders who are very problem solution oriented, and then you are bringing this whole other angle with the business consulting expertise that you have, and also like having looked at markets from a very general overview sort of.
Yeah, I think maybe at some level, but I think, look, I spent 2 years in consulting. I think that was great. It was a great job out of college, but I don't. In fact, what's more useful than that, I think, is just the experience of having seen some of the 0 to 1, 1 to 100 journeys. I think consulting was great. I think a consulting, or for that matter, any business operations role in a large organization, even say if you were just a BizOps person at Flipkart or Zoho or Freshdesk, you probably get a similar experience that, you learn how to think in a structured
Yeah.
fashion.
Maybe
I think, yeah,
the additional thing I want to bring up is, like, let's say, for example, a wellness company. You've seen 20 other wellness companies, for example, right?
right.
So the fact that, I mean, you have some comparative sort of a knowledge of these, the way these companies are operating, etc., could come to bear in these sort of interactions, right?
Yeah, I think that is exactly what I was saying. You're right. I think that's what's more useful. I think the fact that
Yeah.
you've, managed to see a lot of these companies and a lot of the portfolio as well. Like, for example, like on the consumer internet side, having 8 consumer internet vertical companies in the portfolio. When you meet a new consumer internet company, you're not, it's not like just in the air. You've seen those journeys. You've seen, look, you know what, your CAC is going to fall after you do, X, or your CAC is going to rise after you do this, or TV works, do TV in this way. Like for example, a lot of some of these are just insights which you realize because of the experience, because of having worked for so long and having seen some of those journeys and being fortunate enough to see those journeys. So that definitely helps. And I think, but I do want to give credit to the founders. I think a lot of time, look, founders are, it's not that they don't know these things. It's just that it's about two different perspectives, right? Like when I am looking at, let's say if I am looking at a female focused fashion e-commerce company, I am trying to understand that, hey, look, returns are super high in this segment. Waste, your inventory turns are low, so your working capital is high. It's a category which has not seen breakout leaders. There are maybe two companies, there's TCNS or something. I mean, there's no other very large companies apart from Mitra. So I am coming from that perspective. I'm coming, okay, what all hasn't worked? Let me just probe on that. Whereas the founder is coming from, they also realize those things, but I think the founders just by nature are far more optimistic. They're also supposed to be, because they're the ones who are running it. So, in their mind, those risks don't exist because they've already thought of it and kind of solved for it. So I think it's just about two people looking at different things. Like, I'm looking at these three or the 10 things, the founder is looking at these three. And I think that's, what is called as an investor founder matching. Sometimes you always want a founder who is complementary, and a founder should try and get an investor who's complementary, because if you're just saying the same things, then you're like kind of in like an echo chamber. Like if I'm like, oh, you know what, female internet commerce, so huge, so big, great. And the founder is like, yeah, absolutely, so big, so huge. And then they're just two people sitting and just getting happy about something we've realized, but not really doing anything about it. So yeah, so I think it's helpful to have these different perspectives about the same thing.
Yeah. No, I often wonder, how these, how do you sort of hold back on these interactions, right? Because what happens is like, as a founder, you have to be slightly more optimistic, and as an investor, you have to think about risk, right? I mean, that's the biggest factor in the business. So how you sort of marry both of these and not kill each other, in the process is.
Yeah, no, I think it's about the way that you said it. Like, it's the risk, it's the problem. It's not a deal breaker. Look, when somebody started, like for example, when somebody started making electric cars, of course there was all the risks in the world. I think the question is, what you're trying to look for is not somebody who solved for it. What you're trying to look for is, do you recognize the risk? Do you appreciate the risk? And do you appreciate that you're going to have to work hard to, move away from the risk? So I think, and that's usually, at least my conversation is always like, look, that, in this category, gross margins, for example, let's say there's a category which fundamentally low gross margin. Like, look, this category has a low gross margin. It's been hard to scale a business here. Now, one answer can be the founder is like, oh no, the gross margin is not low. At which point I'm like, but it is, right? And or the founder is like, yeah, the gross margin is low, which is why we're working on these three things to make sure that our economics still works. And that's the kind of a response you want. You don't want somebody to be like, I don't think this is a risk. I think what you want is somebody who's like, hey, I agree this is a risk, but you know what? I have thought of it. It's not
Here's how I'm solving it.
Yeah.
Right. So you also work pretty closely with Swiggy and Urban Company, and something I was curious about is the fact that these are logistics heavy businesses, and considering everything, how it has come to a grinding halt. I mean, now not so much, but then I mean this year has been pretty weird that way, right? I mean, I've really wondered how these businesses pivoted and in fact have dominated the market this year. So can you give us some insights in terms of how some of the decisions were made, and what has happened over the course of this year with these companies specifically?
Yeah, so in full disclosure, Swiggy is a company which we were investors. We sold a little bit of our stake. We're not actively involved on the board anymore, so not that close over there. I think UC definitely. I think Urban Company. I think it's been a phenomenal story. If somebody told you in March that company with 35% of the business or whatever, 1/3 of the business is related to beauty, personal care, people coming to your house. In fact, the entire business is based on people coming inside your house.
Exactly.
And that's going to
in a pandemic.
I think people were like, this is not going to go anywhere. But look, I think what you need, that there are two things. One is, if you're solving, there are customer problems, and those problems don't go away. Just because a pandemic happened, it doesn't mean that you don't need a bathroom cleaning once every X number of months. And just because a pandemic happened, it doesn't mean that you don't need beauty services once every X number of days. In fact, so the flip way of thinking about it, and that's actually what the company did. They were like, look, you know what, we are a lot more important right now, because hey, we're the only organized player, we're the only player who can tell you that, look, this person was, this is the contact tracing of this person, this is the temperature, this is their COVID positive negative status, because we're organized, as opposed to the entire unorganized segment here. So it's about how it's like the glass half full, half empty, right? You could have said that, what, this business is going down the drain because nobody's going to have people in their house, or you would be like, people are going to have other people in their house, but in fact, we should work extra hard to make sure that our people are, better, kind of, they're safe. We are paying importance to hygiene, we're paying importance to safety, we're tracking, we're contact tracing, making sure everybody has the right, app or whatever it is to track what they're doing. And I think that's what the company did. I think, phenomenal work by Abhinash and the team. They just, put down very stringent safety standards. Everybody has to, mask, PPE, sanitizer, check, take pictures, Arogya Setu app, temperature monitoring thrice a day. Like, they just went overboard, in fact, and that was good, because suddenly people were like, what, I would prefer to get my hair cut at home from an urban company person, because they are going to wear a mask, they're going to wear a shield, they're going to show me their Arogya Setu status, and if they get COVID in the next 7 days, I'll come to know because they have the Arogya Setu app, and I'll be better aware of what's happening. And I think that was just what worked. And then one very interesting thing that Abhiraj and Varun and the other founders did was, they posted videos of themselves doing the services. Like, there was a video of Abhiraj getting a haircut. And that just tells you, look, if, you have to put yourself where what you're saying is, right? Like, that just tells you, look, what, if I am comfortable doing this, then all my customers should be comfortable. And I think that really worked for them.
That's like real skin in the game, right?
Real skin in the game. You're like, look, I am getting my own haircut here. I'm getting my own house cleaned here. I'm getting my own AC cleaned, with these people. And so if I can trust them to come, and these were not like staged conversations, they were like actual people who came in with the proper mask protocol, everything, and they just did it. And that just, I think, some of these categories grew like crazy, and I think urban companies are one of those businesses which has actually benefited from the pandemic. Yet in March, if you ask somebody, they would have been like, oh my god, this business, who knows what's going to happen to it.
Seriously, right? I mean, so I got a haircut on urban company for the first time this year. So that was pretty interesting.
Why did you choose urban company? Why, like
the same thing, right? See, like, so I went out to my usual salon, and I freaked out almost immediately after I came back, because I just started overthinking. I was like, holy shit, what's going to happen if this guy tests positive a couple of days later or something, right? I mean, how would I know, and obviously, I mean, since it's a haircut, you can't really keep wearing a mask or anything. It's not like stepping into a restaurant or something like that, right? So and picking up an order or something like that. So so after that, I kind of did my first urban company purchase, and I was quite happy, actually. The guy had a mask on, everything, and and of course, I mean, you have all that contact tracing element and stuff like that. So yeah, I mean, I've had 3 haircuts this year, all thanks to urban company. So
yeah, see, I think it's just that
it's a lot more formal, right? I mean, it's a lot more organized, and you kind of the number of variables are less, I would say, right?
Yeah, I think if you go deeper into it, the variables are the same, but they're just controlled. They just identified the problem. Like, earlier, the problem used to be finding a barber, but now the problem is finding a hygienic, safe barber.
Correct.
And the hygienic safe is just so much more. Like, people are like, what, it's okay if my haircut is not 100%, if it's 80%, but I need to be safe. And I think that's just, I think all credit to the team for just figuring this out so fast and really executing this. And I think it also helped them on the professional side. Remember, this is not just your problem, it's also the problem of the professional. Imagine you're a beauty professional, you're like, look, I have to do this for work. This is my living.
Yeah, more so for them, right?
Yeah, exactly. But so you also have to convince them to come into work. Like, Big Basket, great example. Lockdown happened. migration started to happen, and there
Yeah.
was no workforce, and everybody was scared, and
Yeah.
nobody wanted to come. And then, once again, a great example of a company which just worked so hard. They instituted full insurance policies, medical checkup. They were
Yeah.
like, look, first priority, we'll take care of you. You don't worry. You're insured. We'll cover your medical costs. We'll break you up into shifts. We'll make sure you're all self-isolated. We'll give you all the mask PPE. So at first you are safe. Then you know what? We'll give you extra pay so that you work, because you're working here.
Yeah.
Then we'll make sure our customers also wear a mask. So like, it's about how you think as a company. And I think
Yeah.
great credit to all founders. In fact, I think most companies manage to do this, and it's just a great kind of thing that they did.
Yeah. See, the other aspect that I noticed particularly this year is a lot of buybacks, right? ESOP buybacks and stuff, which is, again, I mean, it lends a lot of confidence in the business itself. I mean, urban companies certainly did announce, and then you had Zomato, Swiggy, all of them. How do you read this?
I think this is just my personal opinion. I think it's great. I think it's coming
Yeah.
of age of a startup ecosystem which has kind of been taking these things for granted a little bit.
Yeah.
I think a lot of people didn't really understand what ESOPs were, didn't really know how to use them, weren't sure whether they're going to be of value. And I think it's great that people are finally doing this. I
Yeah.
think it just allows more people to work for a startup. Like it allows you to think, what, I can have a share of this upside, and not that, hey, I have this figment number. I don't know what this is ever going to be, because let's face it, a lot of these companies are not going to go public or get acquired very early. These are 7, 10, 12 years, 15-year cycle businesses, and your employees will not always have that. Like as an employee, if you worked 5 years at a company and you want to move on, that's absolutely fine. Yeah, right? There's nothing wrong in it. You should get rewarded for that. And if there is a periodic buyback, so I think it's fantastic that people are doing this, and all credit to the founders for making sure that this happens. So I can tell you, it's not very straightforward to just do this. It seems very easy. Oh, I will make this happen, but you have to convince your board. Like there's a lot of jing bang which happens around it. It's all credit to the founders who made it happen. All credit to the investors on the board, all the board directors who made it happen. And I think I do sincerely hope that all companies should start to figure out a buyback budget, because I think it's soon going to become the norm. Because if you have a company like Urban Company, which is like, what, every year I'm going to do buybacks. As a good techie product person, you never want to go to any other company. Like, why would you? Because you're like, hey, this company is going to buy back my stock, so they're going to put their money where their mouth is. And so I think that is a fundamental shift which is going to happen. That founders are going to have to create a line item in their P&L or in their plan for, hey, buyback. And maybe it's a way of incentivization, maybe it's a way of retention. I don't know what it is, but it's going to happen.
Yeah. No, for sure. I mean, even from an employee perspective, it's not some mythical moment in time when you're actually going to be able to monetize all of your equity, right? So it certainly reinforces that commitment, I would say, in working for a startup, for sure. Yeah. Yeah. So, I mean, venture capital itself has become so competitive, right? I mean, over the last, couple of decades, especially over the last decade, you're seeing a lot of, growth stage funds even do early stage investments right now, right? I would say, Series A and like pre-Series A and so on and so forth. Bessemer is one of the oldest VC firms, right? I mean, you have like over 100-year history, which is, amazing, pretty amazing, right? So how do you still manage to be like the top choice for, amazing founders out there who are looking to start up companies?
I think, look, there are two ways of thinking about it. So I think first is founders choose to work with you because of other founders' experiences and the quality of people that you have in your firm. And I think at Bessemer specifically, I think phenomenal quality of people at the firm. Like I think, and we operate as a single kind of fund across the world. So I think across the globe, fantastic set of people. I feel very lucky to be considered like equivalent to them to be kind of working here. And I think that just plays a huge part, because as a founder, you are choosing a fund, but you're choosing a person. That is the person who's going to be on your board. You're kind of professionally marrying that person, so to say, for the next 7 to 10 years. And it's all about the people. You may have a fantastic track record as a fund, but if the founder does not like the specific partner or principal or VP or whoever it is that is working, with them, they're not going to choose you as a fund. And I think specifically, a lot of times people think that it's only the partners or it's only like the 3-4 people at the top. It's actually every single person. I mean, we have personally invested in one of our companies where like even the analyst and the interns, like their behavior, the way they evaluated, the way they had the conversations, that led to the founder being like, what, the fact that somebody who's an intern at your company has this kind of a work ethic tells me about what's the kind of work that you want to do. And I think that's just very important, because especially as new funds like you said come up, the quality of people that you have, the quality of engagement that you have with your founders, and the kind of net promoter score you get from your founders. Do your founders recommend you? I think those are the kind of things which help you make a difference. That's one way of looking at it. I think the completely other way of looking at it, which is a very transactional way of looking at it, is I think look, there's always going to be, India has a lot of early stage funds, but I think there is still a large white space as far as growth capital is concerned. Like if you think of the funds who can write a 50 million, 100 million check.
There are not enough growth funds, right?
Yeah. So I think that's the other way to see it. I think there's always going to be, like, we are not at that space. Like, for example, in the US, there are more than enough number of funds at every stage, every sector. I don't think India is there yet. So I think for the next, yes, there's been a huge explosion, particularly on the early stage side. And I think early growth, still a lot of white space. And if you're a fund operating in those spaces, I think just by the nature of not being enough players, you do. I mean, if you're a fund which can write a $50 million check in India, like, each and every deal is going to come to you, like, because there are like 5 people like that, or whatever, some finite number.
Right. I've often wondered, how do you track the progress of a VC firm itself, right? Because you will know the value of your decisions maybe 7 or 8 years down the line, right? Yes, you can look at IRR and things to that effect. But then, is there, like you mentioned, net promoter score, right? So is there some metric that indicates that, okay, you're on the right path as a fund?
See, I think, look, there are many ways to look at it. I think eventually the only right metric is, are you able to return capital to your limited partners? Are you able to make gains for them? Because that's the only thing that matters in the end. And yes, that's usually a 5, 7, 10-year journey. I think in the interim, I think each fund looks at it very differently. I think we look at it in terms of our engagement with our founders. I think it's not about whether you're investing in one company or 10 companies, or investing $1 million or $100 million. It's about, if you invested in a certain company, are you sticking with them? Are they sticking with you? Are you able to follow on in their rounds? Do they want you to follow on in their rounds? And are you able to sustain that relationship? Because I think if you have, if you invested in a company at the seed stage and now they're raising like a Series E, Series X, Series whatever round, and they still engage with you, they still talk to you, they still ask you, questions and guidance, for me, that's success, because that you've demonstrated that you're not just money, you're a active partner in building the business. And then whenever the exit comes, you know what, that's fine. But that just tells you that people value you as an investor and you've done something right. And hence you're always going to be able to see new deals and be able to get inside the deal. So I think for me, that founder-investor relationship with your companies is a great indicator of how well you're doing, because usually that tells you if you're doing something right or wrong.
Right. Okay. So let's switch up the pace a little bit. Okay. We're going to do something like a rapid fire round. I'm going to shoot you some venture terms, and then, you give me your immediate thoughts on that. Right. And like one or two sentences.
If I don't know what those terms mean.
No, I'm sure you would have, come across these, right? So give me your thoughts on the following. So solo GPs.
Sorry?
Solo GPs.
Great concept, hard to pull off.
Okay. Super angels.
Founders who made a lot of money and don't know what to do with it.
You're good at this, man.
Just kidding, man. Just kidding. Want to make sure there is nobody takes this the wrong way. Super angels, I think, fundamentally important for the ecosystem.
Right. Okay. Rolling funds.
Very interesting new concept. Know a guy called Prasanna who's doing one. Shameless plug for his fund.
Yeah, we
Uh,
had Prasanna on the
yeah,
podcast
yeah.
sometime back.
But very interesting concept. Very, very interesting concept. Just don't know how it will work out, but very interesting.
Okay. SPACs. You can be
Uh,
honest.
it's private equity for the public markets.
Okay.
Yeah.
Okay. One thing that every founder should know.
You're building the company for yourself, not for your investors.
Okay. And one thing that every investor should know.
The founder is building the company for themselves and the customers, not for you.
All
I
right.
think, yeah, I think for some reason, Indian founders and actually founders across the world, there's just so much importance to the investors. And as an investor, I mean, it's great. Like people try and give me importance, it's great. But a lot of times people take decisions around funding, around we have to do this because this investor says that's not. You're building for your customers and for yourself. If you don't want to take venture money, don't take it. If you don't like an investor's money, don't take it. If your customers are happy, if you're happy, you're satisfied. I think that's the most important thing.
Okay. What is the best story you've heard of in the last 6 or 7 years in VC?
In like best in what way? Like there are several.
Most interesting story.
Most interesting story. So I think, look, so there are two that come to mind. I think one is very intrinsic to us as a fund. So around 2016, 2017, we were looking at a lot of fintech companies. Okay, there was this time when fintech was just like the hot thing, and everybody was trying to build a fintech company. Everybody was trying to build a new fintech lender, and every company, and we met like 30 odd companies. Okay, like 30, 40 odd companies, and you're like, look, in all these companies, you know what? They're all using this one software called Perfios. And that's how we discovered something called Perfios exists. Because all of these lending companies were using Perfios to like scan bank statements. And we're like, hey, you know what? Let's talk to these guys. They're building something interesting. Yeah, so that's I think one. I think the second is, just the story of Swiggy. I think how this is again way back in 2014. Okay, like October, November 2014. One of my friends used to live in Indranagar at that time, and I was at his place, and he's like, "Oh, you know what? Let's order food." And I was like, "Yeah, what's the point? Let's just go get it. Like, we're in Indranagar. We walk down to 12th Wing, buy the food, and come back. It'll be faster." He's like, "No, there's this new company. It's called Swiggy." Like, fine, whatever. And then he orders, and and I don't remember who it was. It was either Harsha or one of the founders actually came to deliver, because that was like super early days for them, right? The founders came to deliver, and they like spent 10 minutes at the door, and I'm just waiting inside. I don't meet these guys. That's a completely different story that how we invested. But my roommate, this friend of mine comes back, and he's like, so I was like, why do you take so much time? So he's like, oh, I was giving them feedback, because I'm like, for 15 minutes. He's like, yeah, the founder of the startup was there. You should meet them. And I was like, okay, that's how I discovered there's something called Swiggy exists. And then of course Axel invested, I think, and then we invested much later. But you think of it at that time, 2013, some of these founders were doing the deliveries themselves, and that's just, I think it's a fantastic story.
Yeah, that's phenomenal. Yeah. No, I had a similar experience with Dunzo. I mean, the Dunzo founders used to deliver as well. And, back in the day, they were like a WhatsApp service, right? So
Yeah.
they weren't even like an app as such. And
Yeah.
imagine giving product feedback to what is now the best product team in India, right? So
Right. No,
yeah.
it's just phenomenal when you think of it. And like, you heard these stories about, that Sachin Bansal used to deliver books on a bike.
Outside Gangarams, yeah.
Yeah, exactly. And you're like, Acha, does this really happen? And then, but you're like, oh, this does happen. And
yeah,
if you think of it like that, every time I meet a founder, the biggest thing in my head is, what? There's probably going to be one of these meetings 5 years from now. I'm like, shit, that's what I told that person. But, this is what they've become now, like he or she, whatever. Like,
yeah.
I think that's just this, like, that's the beauty of this ecosystem, right? You don't know what's going to happen 5-7 years down the line.
Yeah. One of the things that epitomizes that spirit is Bessemer's anti-portfolio, right? I mean, which is, sharing all of these successes that you guys passed. I mean, that's one of my, I mean, that's pretty amazing. I feel that it's like it echoes the spirit of the startup ecosystem in some sense, right?
Yeah.
Anant, this has been a fascinating chat. Really interesting conversations. I learned plenty of things talking to you. Before we end the podcast, I want to learn from you what you learned this year. This has been a pretty exceptional year, right? What did you learn this year, and what will you look forward to in 2021?
So I think professionally, I think what I learned was, I think there is there is the standard innovation that we talk about, and then there is innovation when there's no other option. And I've seen some of my own portfolio companies, scrape out unit economics out of nowhere, scrape out new customers out of nowhere, scrape out new operations models out of nowhere. And it just told me that, look, it's never, you can always make things happen. So I think that's just on the professional side. On the personal side, I think the ability to realize how much time we waste in travel.
Yeah.
Like I just have found like so much more time during the day to exercise, to read, to spend with my family, to talk to my friends, because all of this, this imaginary travel time, taking a flight, taking a cab, this, that, blah, is all gone. Yeah, so I think those are the two, just like better time management on the personal front, and professionally, never say die. Like, there's always some new innovation that's possible. I think those are the two biggest learnings. 2021 is going to be super interesting because I think a lot of businesses, like there has been a lot of seed series A activity in the ecosystem, and all of those businesses are going to mature next year.
Yeah.
A lot of businesses which raised at very rich valuations are going to kind of face the test of time. So I think it's going to be interesting to watch some of the new businesses grow and some of the established businesses prove or grow into their, very lofty valuations. So I'm looking forward to both those things.
Fantastic. Hey, this was a super interesting chat. Thanks so much for your time, man. This was really fun, and hope to talk to you soon.
Yeah, no, likewise. I think it was great to be here. Thanks for asking all insightful questions. Hopefully, it is not too boring for your audience.
No, it was super interesting. Thank you so much again, and wish you a very happy New Year.
You too, man.
In advance.
Very happy New Year, yeah, and all to your entire audience. Happy New Year to everyone. Hope 2021 is fun and safe for everybody.
All right. Cool.
Thanks, Roshan.
Thank you. Bye-bye.
Bye.